Hi, good afternoon, everyone. My name is Oscar Jonsson, and I am running the Center for the Governance of Change, who are hosting today's research program on sovereign wealth funds. First, I would just like to welcome all of you for coming to today's launch, and I would like to mention a few things about what we're doing at the center. The Center for the Governance of Change is an applied research center researching emerging technologies, how they're shaping the future, but also most importantly, how to govern this change. What should we do about it? We are working with international organizations such as G20, the UN, WEF, and companies such as IBM and Santander to really bring top-level research in an applied manner to be policy relevant. We're having 9 research programs ranging from the future work in higher education to how AI, IoT, and big data is impacting healthcare to geopolitics and the technological arms race of today. What we do at the center is we're also providing trainings to top-level leadership in both private and the public sector, teaching everything from megatrends to sector trends, but also using design thinking exercises to hammer out what these trends means for these institutions and organizations. Today, we'll talk about the research program on sovereign wealth funds. Sovereign wealth funds are not only the biggest collection of money in the world, but they're also very concretely shaping the future. How sovereign wealth funds are spending their money will make an impact in the 10-20 year perspective, what will actually come to fruition. We've been happy for a number of years to host this unique research program, and we're really happy that all of you are joining today for the 2020 report on what happened last year's, the big investments. This research would not have been possible, of course, without the generous support from our partner, ICEX, or Invest in Spain. And I'm very happy to welcome Alberto Sanz, who is Director of Finance and Investor Relations from ICEX, and give him the floor.
Well, thank you, Oscar. Thank you very much, and good afternoon to everybody. I'm most delighted to be with you today for the launch of the Sovereign Wealth Funds 2020 report, a common initiative for the IE University Center for the Governance of Change and ICEX-Invest in Spain. This report helps us navigate throughout the world of sovereign wealth funds, while at the same time, I hope it helps sovereign wealth funds and investors to navigate throughout different investment trends and opportunities, including in Spain. At ICEX-Invest in Spain, we have long been aware of the significance of sovereign wealth funds in the financing of investment, not only because of their large size, but also because of its role as catalyzers for sustainable investment, as you were just mentioning, Oscar. Some 15 sovereign wealth funds are active in Spain, with a total investment of some 42 billion euros, both direct and portfolio investment. Their presence is quite significant in energy, telecom, infrastructures, real estate, airlines, manufacturing sector, among others. Now, this past year has certainly been very difficult for everyone. Foreign direct investment has fallen by 40% worldwide, according to UNCTAD data. In Spain, data show a rebound in the third quarter 2020, balancing the previous drop of 11% during the first months of the pandemic. Trade is also following this pattern, sharp decline during the first months of the pandemic and rebounds starting by the end of the year. The uncertainty and the travel restrictions have impacted many projects that are being held in a wait-and-see situation. At the same time, we see a lot of activity in venture capital in Spain, with record numbers of deals and investment despite the pandemic. This uncertainty and the need to use available funds for many other purposes beyond pure investment has also meant a decline in the overall activity of sovereign wealth funds. In the case of Spain, the report shows 12 different investments up to 1.3 billion euros. Spain managed to remain in the top 10 destinations during the reference time of the report, ranging from January 2019 to September 2020. We have seen, for instance, new operations at Cofides, the Spanish company for the finance of development, throughout the common fund held with Oman. This common fund has been investing in renewable energy, industry 4.0, biotechnology, agrotech, and so on. We have also witnessed some operations in the real estate and hotel sector, but I would like to draw your attention to the increasing collaboration between sovereign wealth funds and Spanish companies to develop projects, not only in Spain, but also for third markets. Two big Spanish companies like Naturgy, natural gas, and Grifols in the med sector have closed deals with sovereign wealth funds in Kuwait and Saudi Arabia, respectively, for the development of wind energy projects in Australia and in the medical sector in Saudi Arabia. These cross-border projects with co-funding of sovereign wealth funds can certainly pave the way for many other opportunities for large Spanish corporations operating worldwide. I would also like to highlight the increasing importance of sustainability criteria for investors, including sovereign wealth funds. Sustainability is not only a purpose in itself. The good thing about it is that it also makes sense in terms of returns, since investment in sustainability is clearly outperforming traditional investment. In this sense, the post-pandemic recovery funds being developed in the EU, the so-called Next Generation EU, will attract unprecedented amounts of funds for new sustainable investment projects all across the economy, aiming at the digital and ecological transformation of the Spanish economy. This will be a unique opportunity to find partnerships to develop these projects and exploit synergies with sovereign wealth funds and large institutional investors. At ICEX-Invest in Spain, we remain open to explore with you any project or idea you may have and help anyone navigate through these new opportunities with the confidence we will help you find the right partner. I thank the IE Center for the Governance of Change for this great collaboration in the preparation of this report, and I wish you all an interesting and fruitful session. Now, I leave the floor to Javier Capapé, Director of Sovereign Wealth Fund Research in the IE Center for the Governance of Change. Javier, the floor is yours. Thank you.
Thank you very much. Thank you very much, Alberto. Thank you very much, everyone, for attending this session today. Welcome to the event. It's a big pleasure to have you all here, and we are launching today the international, let's say, presentation of the report. We have an amazing session ahead of us. We will be talking about the best highlights of the report. It's a report, as you know, that has been produced considering a time frame between, well, in terms of data, July 2019 up to September 2020, covering the whole pandemic year. It's an exciting year for researchers because many things have been either accelerated, either stopped during the crisis. Of course, it's a quite, as you probably personally have experienced, painful period. So I just want to send you a message of courage in these complex times. So let's go directly into the presentation of the report. Let me share with you the screen where you will see some of the, let's say, main conclusions and lessons that this pandemic has brought to us as analysts of sovereign wealth funds. So get ready for the presentation. Okay, so let me start first with the thinking a little bit, some of the main contributors or the contributors to the report this year. Some of you may be aware, if you have followed the series of sovereign wealth fund reports brought to you by ICEX-Invest in Spain and the Center for the Governance of Change at IE. Patrick Sena, I want to start with him. We have collaborated for many years now. At least the first collaboration started dated out of 2013. So thank you very much, Patrick and his team. I think some of you are also joining the presentation, Garima and Mary, for co-authoring the first chapter on the let's say the overview of deals. We have Adrián Blanco, who will be joining us later on, explaining some of the main highlights of the chapter made on Latin America. We will also have our own particular session later in the year on Latin America and sovereign wealth funds. And of course, Paul Ross, who is joining to the panel today from the Moritz School of Law in Ohio State University. Welcome, Paul. And Adam Dixon, who also co-authored the in-depth chapter this year on the China Investment Corporation in partnership or co-authoring with Imogen Liu. I don't know if you are here, Imogen, but thank you very much for your collaboration. And let me also thank my research team here at the Sovereign Wealth Research Center in Madrid: Alejandro González, Alexander Bent, Daniel Arango, Drew Jonsson, Silvia Gomez, and Rodrigo Arce. And last but not least, I want to also mention two other people. First, Covadonga Fernandez and Susana Millán who have prepared all the infographics that you will find in the report. We have made this special effort on visualization of data since the beginning of the series. So thank you very much for your work. And also I want to thank the team at the Center for the Governance of Change, starting with Oscar, who talked to you just before, Carlos Luca de Tena and Lourdes Zurdo for her assistance, and her support to many of the things that you will see happening today. So also Susana Malcorra, the Dean of my school, and that's it. So I wanted to start with thanking many of the people who are behind this report, because all the success of this product and the visibility of this research is due to these people. So thank you very much for your contributions and your collaboration. Let me just continue with jumping directly into the meat of the report, which is basically to talk about the top 10 sovereign wealth funds. What are the 4 things that we can learn out of this slide? First thing is that sovereign wealth funds for the first time in history have surpassed the barrier of the $9 trillion US. So for the first time, we have sovereign wealth funds accumulated assets under management beyond 9 trillion. Just to give you an idea, the total foreign exchange reserves in the globe, in the world, are around 11 trillion. So sovereign wealth funds in terms of size is getting closer and closer to the total foreign exchange reserve pool of assets in the world. Second thing is that the sovereign wealth funds that grow faster and more are Norwegian sovereign wealth fund, the one managed by Norges Bank Investment Management. This one that you can see in the first position, the Government Pension Fund Global. The second one growing faster is China Investment Corporation, followed closely by Temasek in Singapore, and the Russian sovereign wealth fund, who decided to merge into one sovereign wealth fund 2 years ago. If you sum the size of all these first sovereign wealth funds, if you take a look about the countries, you will see that these 10 sovereign wealth funds belong to 7 different countries. If you sum all their assets under management, they will represent a country that will be ranked in the 4th position in terms of GDP after the United States, China, and India, right? So just to give you a sense of how big is the industry that we are dealing with today. And the 4th thing I want to mention is that these sovereign wealth funds, because of their size, may bring, let's say, paradoxes such as, for example, in the case of Norway, the size of the sovereign wealth fund is 3 times the size of the economy there. So if you multiply by 3 the GDP of Norway, calculated in terms of parity of purchasing power, you will see that if you multiply the GDP of 2023 times, estimated GDP, you will get the size of the sovereign wealth fund. So just to give you a sense of how big these players are in the global industry, but also in comparison to their national economies. In terms of growth, we have observed a continued steady growth in assets under management. Over the last 5 years, the assets under management of the sovereign wealth fund industry has grown 25%, representing a tremendous growth pace, but also showing that there is a growing heterogeneity that we will see in a minute. Where are these sovereign wealth funds located? That's maybe the second question that you may have, right? What is their size? Where are these sovereign wealth funds? Of course, you may know that there are 94 sovereign wealth funds, 95 this year. So you may think that, okay, they will be represented more or less homogeneously in the territory. Let me show you how it is in reality, right? This is sovereign wealth funds established before 2010, right? And let me go quickly here because this is just like the history of sovereign wealth funds. Before 2010, these were the members. So these are, let's say, the mature sovereign wealth funds in the industry. But many of them have been established since 2010. So you will see other geographies being like more active in this in terms of this new sovereign wealth fund activity. And you have, for example, a lot of them in Europe coming up. You have also Africa, Central Asia, and of course, Latin America and the Caribbean. And these are countries that are deciding whether to have a sovereign wealth fund or not in the coming years. Here you have the full map. Basically, we talk about this full map of sovereign wealth funds, the sovereign wealth map, as having 4 big poles. You have the first pole in Norway, more than 1 trillion in assets under management. You have a second pole in the Middle East, in the Gulf Cooperation Council countries, representing more than $3 trillion. And then you have China itself, which as a sole country is the largest in terms of sovereign wealth, represented more than $2.7 trillion. And then you have Southeast Asia, mainly Singapore. Singapore, and we will see that now, they are the most active sovereign wealth funds on earth. They have a quite active workforce who is able to deploy capital in a very quick pace, and they are able to reach many industries, many geographies, with presence through international offices, with partnerships, with co-investors, and through sourcing deals in a very, very impressive pace, even for other peers in the private investment world. So next, what we will do is basically to understand, okay, this is more or less like the stock variables, where they are and what is the size. It's something that changes, but not dramatically every year. What changes substantially is the number of deals and the main players. So we will go now with the highlights about the 2020 analysis that we covered in the report this year. So this is the report, and this is basically the time period we covered, July 2019 up to September 2020. There are 165 transactions. If we compare that to our previous report and we adjust to the time period analyzed, the number of transactions have not changed dramatically, almost less than 3% in terms of the transactions going down. So transactions have remained stable. If you look at the sovereign wealth funds participating, this is one of the big stable variables in the sovereign wealth fund family or analysis. It's a quite stable how sovereign wealth funds, more or less the same group of 10 sovereign wealth funds, tend to invest on a regular basis more than the others, much more than the others. So they are like leading in terms of who is behind sovereign wealth fund activity. It's just a small group of, instead of 94 sovereign wealth funds, 95, it's just 10 of them. We will see that in terms of value, there is an important drop in terms of the deal value where of the transactions where sovereign wealth funds have participated. And here, of course, we also have always a caveat in terms of data. It's not that easy to estimate what is the participation of a sovereign wealth fund in a specific deal, right? Think about real estate deal, 3 billion deal in a portfolio of logistics or in a large real estate development. It's not that easy to identify, okay, what is the stake of the sovereign wealth fund investing in this total value transaction. So what we will see is total value transactions unless we say the opposite. And in terms of that, I can tell you that there is a 30% drop in terms of the value of the deals where sovereign wealth funds have participated this year, right? And if we adjust the time period to our previous report, this is explained, of course, by the pandemic, the limitations to access new deals, and of course, the reorientation. And we will talk about that later on, the reorientation about domestic issues that many sovereign wealth funds have started to do during the crisis, because the need of a different use of sovereign wealth funds. We tend to think about them as entities or vehicles that are investing globally, and that's true, but we have seen a tremendous trend even before the pandemic that was accelerated by the pandemic of a different use of sovereign wealth funds, more focused on domestic issues. And that's something we highlight, for example, in the first report, in the case of Turkey. That's something we highlight also in the case of Spain. We have seen that in the case of Ireland and Russia, right? So we will see how sovereign wealth funds pretend to look outside and they want to do international investments, and they have that presence, even opening international offices. But at the same time, they have realized they can use these resources accumulated, particularly in the case of Latin America, and that's something that Adrián will showcase later on. We will see how this domestic focus have also been reinforced by the pandemic, and they need to use these sovereign wealth resources in a strategic way. Right? So beyond this, I want to focus now in the main, let's say, to highlight a little bit of, okay, we have seen deals. Some of them are very large deals, something that we call the mega deals, right? And there have been 8 of them in the period that we cover in the report. So let me show you what kind of things they have been doing during in terms of the mega deals. And sorry, because I see I've just added these funds before the end. So let me highlight some of the big deals that sovereign wealth funds have participated in during this pandemic year. The first thing, if you look at the top of your screen, you will see an autonomous vehicle company, Waymo, a spin-off of Google, participated by Mubadala, right? So we will see that this sovereign wealth fund has participated in a Series G round of Waymo, and it's showcasing how the sovereign wealth funds may think about the future of mobility, right? But they are not thinking only about the future of mobility, but let's think about the second deal, right? It's a Beijing, right? It's a Chinese biotech company participated by GAC, trying to get solutions in the treatment of cancer, right? So we have got to know, and that's something we will discuss during the panel, that health is an strategic element of security for countries, right? So having sovereign wealth funds investing more into biotech companies, that's something we will see in detail in another slide. It's of strategic importance. Why? Because we may think about diseases, chronic diseases like these ones, to be solved at some point in time, and countries will want to get ahead of the rest in terms of finding solutions for what are called the urban diseases of the 21st century, right? We also have Geo Platforms. This is very interesting. It's a telecom company based in India. That's the largest, that's the holding, controlling the largest telecom company, operator of mobile telecoms in India. You think about India, it's soon to become the largest, the most populated country in the world. It's a promise of tremendous growth and importance in terms of the rebalance of the world from Europe to Asia. And that's why you have sovereign wealth funds participating in this kind of companies, because they believe about the long-term trends, right? Think about the fourth deal. It's SWFs is a edtech company, so a company that is running e-learning resources, able to reach all the students in China below 12 years, so K-12 students, and they have created this company just before the pandemic. So only the pandemic was accelerating this trend that was already there in China before the pandemic. And I will show you the sovereign wealth funds in a minute. And you have Qatar Investment Authority participating in that deal. And then in the last one, I want to highlight this deal in Equinix. Equinix is a data center company developing these hyperscale data centers that are able to store and to control all the information that we exchange today, as like this call today now through Zoom, that is driven communications online, but not only communications. You think about all the e-commerce in the world, or the telemedicine, all the different ways that we have now to move, to communicate, and to even to eat. And we will see that in a minute. They are supported by sovereign wealth funds. They are very happy to have found new, let's say, physical assets that require an ownership. So they really like to be owners of those things that support the rest of the society. They have been doing that with infrastructure in the past. They have been doing that with real estate that support businesses, that support our residential venues. But beyond that, they tend to believe that the need to position themselves into the future, right? So that's why they are starting to do this kind of joint ventures, like the one with GAC and Equinix, to explore data centers that are growing as a real estate sub-niche sector, and that will be more relevant in the near future. Okay, so after analyzing some of these highlights of the mega deals where sovereign wealth funds are participating, we can see a certain pattern here. So they are exploring emerging markets through mega deals and thinking about the future, right? So some of the mega deals are just suggesting that sovereign wealth funds are not just thinking about what's going on today, but also what the future will look like in the near term. So beyond this quick data fact analysis, we also have, well, this is the average deal size this year, 250, that masks a little bit. Well, one fact that you know about average is that many times they are not really useful in terms of describing the reality, right? These 255 million in the end are divided into two large groups of 22 deals above 500 million, but 40 deals below 100 million. That's relevant because we tend to think about sovereign wealth funds only participating in large scale deals, but that's not true. They also participate in a smaller scale, smaller size sovereign wealth funds, deals. And we will also discuss these ideas in the panel with the participation of Hugo, who is like expert in origination at Deloitte, right? So he's familiar with this idea of, okay, what sovereign wealth funds are interested in or not, right? So we will see that later on. And let me just highlight this last thing that was highlighted in the first chapter of the report. And sovereign wealth funds are able to co-invest more and more, and they do that so frequently. 70% of these deals were made in co-investment. So solo investments only represent 30% of all these deals. And that means that sovereign wealth funds need to engage with other investors, either private or public, to develop their activities. Sometimes they are working as lead investors, sometimes they just follow other investors, but it highlights one relevant idea, is that sovereign wealth funds back in 2008, right? You remember they launched these Santiago principles, right? A framework that was intended to reduce the risks or the fears of recipient countries, reinforcing governance, right? And trying to make all the members, at least now are 35 members of them, to reinforce the idea of governance and having financial motivation as the main motivation for their investments, right? So this movement was created because there was like some fear about, okay, who these sovereign wealth funds are, what do they do? I mean, this idea of 70% co-investment deals tells you that these fears are vanishing somehow, because basically sovereign wealth funds are like any other advanced and sophisticated global long-term investor, and they are now part of the financial architecture. Okay, more things about what's going on this year. This is the picture of the most active sovereign wealth funds. No surprises here. Temasek and GIC leading and representing more than 50% of all the deals. You have Mubadala, Qatar, Russia, and then a group of CDP Equity, Cofidis, and Turkey that are focused on domestic deals. So this is the most active sovereign wealth funds. This is the destination countries, and we will talk about that later on in the panel. Look about the United States and China. They represent almost 40% of all the deals in the period we analyze. We have also the United Kingdom and India. These are the typical top four countries. They may switch positions between UK and India, but this is typically the case. And then you have United Arab Emirates this year. In terms of deal count, if you analyze this thing by the volume of assets that have been acquired, or the volume of assets where sovereign wealth funds have participated, right? You have a slightly different picture. Just simply, you have United Arab Emirates jumping into the second position because of this super large scale deal that they engaged in terms of GIC in ADNOC, the Abu Dhabi National Oil Company. And you have also Mexico because of another big mega deal that happened in Mexico with the participation into the second largest operator of highways in Mexico, right? But still, United States, China, and India, they remain, right? And they are stable over the years in terms of investment destination. Also, let's say not only in deal count, but also in terms of volume. And interestingly, we have these two countries that jump in only this year. And this happens all the time. Last year, it was the Netherlands because another big mega deal, if you remember, in AkzoNobel, and also Switzerland because of the Nestle Skin Health deal. So we always have two countries that jump in and out of the top 5 ranking, but there is a certain stability in the geographic destinations. We will talk more about that later on. Let me just continue with the sectors. We have technology, services, and life sciences leading again, like in the last year, in terms of sovereign wealth fund preferred sectors, destinations. And we keep with real estate and finance that were traditionally more of their interest because they're typically, they are able to deploy larger amounts of capital, right, in single deals. Of course, this is the deal count. If you go into the volume that has been deployed into these sectors, we will see those sectors that are able to, let's say, to assume more capital going into the top. And that's the case of infrastructure, of course. If you think about the volume of dollar assets where sovereign wealth funds have participated, you have infrastructure in the first position, mainly because of these two deals that were highlighted before, either in transportation infrastructure or natural gas transportation. And this brings into an interesting question, and let me just go into some of the trends here that are related with the evolution of the sovereign wealth funds jumping from the traditional sectors to the new sectors. In terms of energy, sovereign wealth funds can be positioned in two sides of the world, right? And let me highlight that with Naturgy. Naturgy is a Spanish and global company that is a utility that has been selling. If you follow the flow, they have sold. You go up their Chilean assets to another state grid corporation of China, an SOE in China, for a given amount beyond 2.5 billion euros. They are using these resources in a continued way to continue filling in terms of activity. GPG, which is the Global Power Generation, a subsidiary of Naturgy, that is a joint venture between Naturgy and the Kuwait Investment Authority to explore renewable energy. I highlight here the example of Australia, which is one of the big pushes that GPG is doing in the last months, but they are of course having a global presence. So this is just to tell you how about this rotation of this asset rotation, right? So you are able to sell certain assets to another company, another owner, in this case State Grid, and you will use these resources in a continued way to start recycling your energy sources and going more and more into renewable energies. So we have here sovereign wealth funds in the new side of the energy world, but we also have sovereign wealth funds participating in the old side, right? So think about the ADNOC deal, right? They basically sold 49% of their ADNOC gas pipeline assets to a group of investors, including GIC, for $10 billion, right? What are they doing with these $10 billion? They are using these resources to increase their capacity into a technology that is helping oil companies to reduce their own impact of their oil extraction and transformation. So basically, they are trying to multiply by 8 their capacity into carbon capture, utilization, and storage. Why? Because they have found a sovereign wealth fund and other investors that want to have the control of these assets for some time. So we may see sovereign wealth funds at both sides of the world, right? In the new and the old world. But in any case, we will see that how the sovereign wealth fund is key in terms of the transition that we can make for a sustainable future. Here are the top 10 industries in terms of deal count. We will not stop too much here. You see again, life sciences leading in terms of deal count. And I want to highlight this year one thing here about, what are the new sectors where sovereign wealth funds are participating? Think about the future of food. These are all companies that are able to produce meat protein without using animals. So basically they produce either meat or dairy products without livestock. You know that livestock represents, agriculture represents 25% of global emissions of greenhouse gases, right, every year. 25%. Out of that 25%, 30% is devoted, is due to livestock. So if you are able to reduce that amount when generating or producing meat and dairy products, right, you can have a tremendous impact in terms of sustainability. This is not just a fashion. It was something before the pandemic, of course, but this is something that will be continued being invested by sovereign wealth funds. You have here the cases of Temasek, GIC, and CDP Equity in Italy, investing in different companies that are doing this kind of transition, right? The way we eat is going to change. The key question here is that, what happened during the pandemic? Were sovereign wealth funds were able to continue their investment pace in VC? That was not true. So basically, we observed a drop of at least 40% in terms of the different funds participating in VC rounds. So only those that before the pandemic were already prepared to invest in venture capital, so they were sophisticated, they have already a program, they have a full strategy, they were able to continue investing, right? But in terms of the number of different sovereign wealth funds, we observed a huge drop during the pandemic year when we had this challenge. It highlights another thing, is that those who were active before and after the pandemic, they increased their investments in venture capital, probably because they think that the solutions to crises like the ones that we had also have, or let's say some of the solutions may come from the startup world, right? One of the changes that has been accelerated during the crisis was the e-commerce growth. And of course, that means that you require a tremendous activity in terms of logistics, right? You need brick and mortar to serve all these products that we are asking, or that they are delivered on a daily basis and every minute into different parts of the world. That requires a lot of assets, and that's why I want to highlight here the case of Spain. Sorry, because of the overlap of this project. These are top players in Spain, 7 top players in logistics in Spain. And if we do this game of finding the differences, right? In the next slide, you will see that 3 of these top players in logistics real estate, industrial real estate, are in fact owned by sovereign wealth funds. This is the case of Norway, the case of China, and the case of GIC. And we highlight that also in the report. So let me start finishing. This is also a very interesting fact, how sovereign wealth funds have invested heavily in hotels, but they are not investing in hotels right after the crisis. That's a sudden stop in terms of hotel activity since March 2020. But just before that, we observed a very strong activity in terms of sovereign wealth funds investing in hotels directly as asset owners of hotels, 1.2 billion in the period we analyzed. And I want to finish here before we jump into Latin America about these ideas of biotechnology, right? So there is a tremendous surge in activity of sovereign wealth funds in biotech during the crisis. So from January to September 2020, we observed almost double the number of deals that we had observed in the previous 3 years on average, right? And these are some companies that have been participated by sovereign wealth funds. All of them now we are all well familiar with these names, right? CureVac, BioNTech, Sputnik, and Moderna. These are all companies that behind some of the vaccines that have been developed in partnership with Pfizer or GlaxoSmithKline and so on in the recent months, right? So who is behind these investments? Okay, among other investors, of course, sovereign wealth funds are looking into this as an opportunity also to gain faster access to vaccine, but also to support changes and support their own populations in fighting this pandemic. So this is just one last slide. I invite the panelists maybe to highlight a little bit of that, but just simply the participation of sovereign wealth funds in rescuing and bailing out some of these companies in the near months, in the near past. This is the case of Singapore and the case of Malaysia. So the report also highlights regulatory issues and a specific chapter on China, written, by the way, by Imogen Liu and also Adam Dixon, who is participating next in the panel. So thank you very much. I will just give the floor to Adrián that will continue with the analysis that we made on the activities of sovereign wealth funds in Latin America. Thank you very much.
Thank you, Javier. Hello, everyone. I'm going to present you one part of the report that Javier and I elaborate on sovereign wealth funds in Latin America. The title is Latin America and the Caribbean Sovereign Wealth Funds from Fighting the COVID-19 to Unveiling Strategic Opportunities. Probably Latin America is not the first region that comes to your mind when you think about sovereign wealth funds, but what is true is that the region counts on several of these institutional investors. As you can see on the slide, the region has 8 sovereign wealth funds that are in operation, 2 in Chile, 1 in Colombia, 1 in Peru, 1 in Mexico, 1 in Panama, 1 in Trinidad and Tobago, and 1 in Guyana. Suriname has recently created one, but it's not yet put to work, and the Venezuelan sovereign wealth fund remains inactive since 2011. And it's also important to say that Brazil used to have a sovereign wealth fund created under the Lula administration, but that was closed 3 years ago by the Michel Temer administration. The total assets under management are 42 billion. And this is the picture, this is the sense of magnitude about what's going on in the region as far as sovereign wealth funds is concerned. So in this piece, Javier and I tried to respond to 3 different questions. The first one is, what was the role played by the sovereign wealth funds to face the pandemic, to face the economic crisis? Well, as you probably know, Latin America has been one of the most beaten regions because of the COVID-19. It's estimated that GDP declined 7.4 in 2020, 2.7 million companies disappeared, and the level of poverty is reaching 30% of the total population of Latin America. So this is a very dramatic numbers, a very dramatic reality. And in this complicated context, we want to highlight that sovereign wealth funds are playing a very important role in responding to this pandemic. The assets implemented and committed to combat the effects of the pandemic and to activate different fiscal packages are $13 billion, and mainly has been implemented by the Andean countries and Andean sovereign wealth funds. Here you have three of them: the Fondo de Ahorro Estabilización from Colombia, and also the Fondo de Estabilización Fiscal from Peru, and also one of the two sovereign wealth funds from Chile. So first conclusion that well, of course the sovereign wealth funds are acting as a fiscal buffers, not only in these poles that Javier mentioned before, but also in Latin America. And there's also probably a lesson to be learned from other Latin American countries that they still have a room to create new vehicles to compensate the economic cycles. The second question that we try to respond here is if sovereign wealth funds can be used to improve the productive model. That is one of the weakest points of Latin America. So it's true that Latin America countries have created the sovereign wealth funds that I mentioned, but all of them are used only as a fiscal buffers. So there's a window of opportunity for a more ambitious sovereign wealth funds that combines this fiscal goal and also development objectives. There's numerous examples that probably most of you are aware of that contributed successfully to support economic development. This is the case of, for instance, Mubadala in the Emirates, that has been extremely successful in the financing and developing sectors such as aerospace, healthcare, renewable energies, and others. And also we have the case of course, Temasek AGS in Singapore, and also other low and middle income countries such as Senegal, Turkey, Malaysia, Kazakhstan. All of that has this what we call sovereign development funds, and of course one of the things that these sovereign wealth funds in Latin America can implement is this canalization of the industrial policy to sovereign wealth funds. So this is our second conclusion, that sovereign wealth funds could be reoriented and act also as a strategic instrument to foster development and productivity in the region. And the third question we want to address is if these sovereign wealth funds will be used also to attract FDI into Latin America. And this is not a minor issue. This is a quite important issue. Latin America has had a low investment level. We have limited the capacity for growing and for development. Just to give you an idea, the investment in the region as a share of GDP is about 20%. That's the average of the last 3 decades. This is 4 points lower than the world average, 6 lower than the Middle East, and 15 lower than the emerging countries in Asia. So there's a clear investment gap, and that investment has to come from external sources for a number of reasons that we explain in the article. So in this context, we think that sovereign wealth funds can also associate to other sovereign wealth funds from overseas, not from the region, and also from foreign pension funds, and also with private equity firms, to create co-investment vehicles and to canalize and to attract foreign direct investment into the region. Of course, there's plenty of examples again. For instance, the Nigeria sovereign wealth funds is co-investment with the sovereign wealth fund from Morocco to create this co-investment vehicle to develop a trans-African gas pipeline. So, and this is the third conclusion, that there's plenty of room again to sovereign wealth funds in the region to create these co-investment vehicles together with other sovereign wealth funds, pension funds, or private equity firms. And in particular, just to conclude, I would like to mention that one of the problems and many factors for explaining what's going on in Latin America and the gap in terms of economic growth and development is the infrastructure gap. And it's very important that this co-investment structure, and in particular with other sovereign wealth funds and with private equity firms, could be dedicated to address this investment gap. That is, as I mentioned, other of the problems of the region. So that's all from my side. And Javier, I'm back to you. The floor is yours again.
So thank you very much, Adrián. Thank you very much for your contribution in the report this year, and also your continued support from ICEX-Invest in Spain. It's been a long period since we started collaborating. So it's an honor, and let me just pass the floor to the panel. We'll start with Adam. Adam will be moderating the session. You know, Adam is leading the Sovereign Wealth Research European Research Council grant at the European level, and he's been contributing to the report in several periods. And I'm really happy to have you here. He will moderate in the panel with Hugo Parson, the head of origination of Deloitte UK, and Paul Ross, who has been with us for so many years now, also collaborating in the report. Thank you very much, Paul. Thank you, Hugo, Paul from Moritz School in Ohio State University. Will be joining us from different parts of the world just to highlight some of these pre-trends and how they are changing the pattern of the sovereign wealth fund activity, and how what to expect in the coming months and years. So thank you very much to all of you, and the floor is yours, Adam.
Great, thank you, Javier. Congratulations on another great report. I just wanted to say it's always a pleasure to see the report, because I've used it over how many ever years that you've started using this report. Every time I need some piece of data or some interesting information, I always go and look at Javier's report on if I want to get the exact number of sovereign wealth funds. So to those that support Javier's work, I really hope that you continue to support his work. I think it's really important, and I'm always glad to be involved. So what we're going to do in the next about 10 or about 15 minutes is that Hugo and Paul and I will have a conversations around the report, but we'll also try to think and speculate a bit broadly around the future of sovereign wealth funds going forward. For those of you in the audience that would like to ask a question, please post in the chat, and I will try to get to those after I've gone through some of the questions that the three of us will discuss, and then we'll finish at 3:15 CET. So I'm going to first start with Hugo, and then I'll move to Paul. So Hugo, in the report, we saw quite a bit of continuity in at least the geographies of where sovereign funds are investing. So it's very clear that they're investing in major markets like the United States, into the UK for various reasons because of its large capital market. But we see increased investment into places like China and India, so growth centers in the world. Can you say something about these patterns that we see? And in your experience, any deviances or variation from what you would have expected, and what that tells us about sovereign fund strategy, or the types of sovereign funds and where they're investing?
Yeah, look, thank you, Adam, and welcome everyone to what I think is a fantastic event, and echo what you said, Adam, in terms of Javier and team being the oracle of sovereign wealth data and information. I think it's a very tough thing to do, so well done, given the opacity of quite a lot of the information. So yeah, it's interesting. I mean, I put them into several buckets, Adam. I think, you know, to try and take it outside the report a bit, I think you also need to look at sources of funding for the sovereign wealth funds. And you've obviously got the oil-based funds, and obviously what I would call the local economy or domicile funds, and that pivots into really two groups. You've got the more active funds from places like Singapore, who are financed and backed by what I would call more broader industry backbones, versus the traditionally financed petrodollar sovereign wealth funds of mainly the Middle East. And I think you can see that in terms of, it was interesting when Javier put up the statistics, by deal value, quite a lot of those deals were inward looking. So you saw some large deals in the Middle East done by Middle East funds supporting their own domestic economies or regional economies. But when you look at deal volume, it's quite interesting. It's much more diversified. And as you said, you know, it's your traditional big five with the US and China dominating the top spot. And then you've got, you know, the UK and India switching for third. And at one point to note is, I thought, given the time period of this study, it's quite interesting to see the UK on there, given, you know, all the noise around Brexit, all of the economists thinking around the UK not being an attractive destination until there was certainty on Brexit. I'm not sure we have certainty today, But what we do have is good visibility of people willing to do deals in the UK and having done deals. And I think, that's a good backdrop for continued SWF investment in not only the big 4 or 5 countries, but as you see more broadly, across the world and across Europe. And I think that's a trend that's likely to continue.
Just to follow up on that geography question. So you mentioned the UK as being an attractive place to invest. Obviously, the report is supported by ICEX, which is trying to attract investment to Spain. In your experience on the question of geography, are there certain things that you see countries doing that are making themselves more attractive to these investments instead of just assuming that the sovereign funds are looking around for great investments opportunities? What's the other side of the coin? Do you see any, in your experience, things that governments themselves are doing to attract sovereign wealth fund investment?
Yeah, I mean, if you start with the UK, which is probably what I'm more familiar with, and I'm sure Paul can also talk about more broadly the FDI question. But if you look at the UK, so by volume, a lot of the deals were pivoting away from traditional real estate in investments, which if you go back historically through Javier's report, you'll see that in the UK in particular, there were a lot of deals done in real estate. And before that in financial services during and after the crisis. What we're now seeing is a more diversified approach, infrastructure by volume is the top sector. We're seeing services, we're seeing tech. And I think that trend, will continue. And so not only will, direct inward investment into the UK from SWFs, be built upon real estate, it's now much broader and it's across different sectors. And the same, I think, is true when you go through the report. You'll see that actually when we unpick some of this, quite a lot of the destination sectors by volume now rather than value are in that tech, biotech, pharma, healthcare, future of food that Javier alluded to. And I think that's quite exciting.
So could you, picking up on the issues of what you just said around sectors and industry, so we did see this shift into pharma and into health, but this was also an investment that predated the pandemic. Can you say something about the pre-pandemic environment that attracted sovereign funds to this and what you expect to happen in the years going forward?
Yeah, look, I think as Javier and team mentioned in their report, a lot of the sovereign wealth fund investors take a long-term view, and they have identified a number of these sectors, including pharma, biotech, and healthcare, as being part of that core long-term investment vision, both domestically and internationally. And I think some of them, maybe it was by luck they invested in some of these just before the pandemic and the huge demand in vaccines. But I think taking a step back, this is a trend we've seen, Adam, for a number of years now. These sectors have become key focus areas, and I think the pandemic will accelerate that. So when you look at deal numbers by volume rather than value, you see those trends in the report. But I think it will only just serve to accelerate more of those investments. My one question, which Paul is probably better placed to answer, is will that trend continue post the current environment, given the number of governmental inputs and restrictions being placed on those sectors? But I think longer term, absolutely yes, you will continue to see those sectors be very attractive to sovereign wealth funds.
Well, that actually provides a nice segue, because we see these interesting trends, but at the same time, we know that the world is changing geopolitically. We see more tensions between large economies. You mentioned Brexit, so the UK leaving the European Union, and what does that mean for economic relations within Europe, within the European continent, or across the European continent. And so we also see a rise in investment barriers, or at least discussions. I know in the UK context, for example, that there's a call for information by the UK Parliament to examine this. So this brings me to Paul. So tell us exactly what is happening on the regulatory front for sovereign funds, right? So sovereign funds made a lot of progress since the global financial crisis, or because of the Santiago principles. We know more about sovereign funds, what they do, sovereign funds themselves. Many of them have become more transparent. But then that was in a period where the economy was open and it was booming. And now we've moved again into a different period where the geopolitical tensions are high. Economies are again starving for cash, but we see countries becoming more, let's say, statist. Tell us, Paul, some of the trends that you see and some of the barriers or problems for sovereign funds before, but also after the pandemic.
Yeah, thanks, Adam. And just to start off, I guess I'd like to thank Javier as well, and IE and ICEX, and this such a distinguished group of experts that contributed to this report, including you, Adam. This is the area that you're discussing, or these trends that you're discussing. As you said, I really do think that they represent sort of an acceleration of things that we've already seen. And that really is a theme, I think, that we've seen in this report in a number of dimensions, that what we are seeing, the kinds of behaviors, the kinds of deals, the kinds of reactions are really accelerations of trends that may have started before. So to answer the question on what we're seeing kind of from a regulatory front, let me approach it from two different dimensions. One is just the domestic responses that countries have made, and then what countries have done when they're taking in foreign investment. So one of the trends that's been highlighted for a few years now is that countries are really turning inward, in the sense that they are thinking very much about using their funds, as Javier spoke about a few minutes ago, to help solve domestic problems as tools for development. Let's say maybe even, as we've discussed, lenders of last resort as a means to help bail out failing industries or struggling industries. So I think that sort of inward turn, certainly the pandemic accelerated that turn. It also made countries recognize that some of their supply chains may need to be shortened. They are worried about having maybe one supplier out there that in another country that in a time of crisis may not be able to continue to provide the supplies that they need. So along with that, you see as a response from governments thinking about foreign investment and thinking about just the way that they want to structure their own economies to sort of protect their citizens in times of crisis. We do see an increase in foreign direct investment restrictions. What's interesting about the data, and the UN Conference on Trade and Development routinely publishes reports on what's going on in this area. And what's fascinating to me is that some countries really are liberalizing. They continue to liberalize. A lot of emerging economies continue to liberalize. A lot of the more developed economies are actually starting to impose more restrictions, in part because they're worried about things that might be considered critical infrastructure. And adding to that critical infrastructure are things like pharmaceuticals and healthcare that really weren't thought of in that way before. So certainly, I think COVID has accelerated that trend that really started maybe 5 years ago to start restricting, I think, foreign investment and scrutinizing transactions where a foreign buyer might, say, merge with a domestic entity. And again, that's happening in the EU, that's happening in Italy, Spain, the UK, Germany, France, the United States, where we see an increase in these kinds of regulations. And I expect that trend will continue for a while, especially because I think that some of the fallout from the pandemic is going to continue, and people are going to recognize that, let's say, politicians are going to believe that they need to continue to impose those kinds of restrictions in order to protect what they now deem as this sort of expanded view of critical infrastructure in their countries.
So on that, do you foresee a more fractured world where, if we go back to what we just talked about with Hugo, where the geography of it is very much US, major growth economies in East Asia, China, India, do you see a possibility of a fractured world where certain sovereign funds are possibly investing in East Asia and others are investing in the United States? And you also, but then those are also the places, particularly in the West, where the barriers will go up. And so what do you expect to happen? And then also you mentioned, right, and we know, I mean, mentioning Latin America, the discussion there where massive recessions happening, but those countries aren't putting up the barriers. So, but will sovereign funds start investing significantly in those places? And just to follow up on that, is the regulator, what does it mean for let's say the governance of sovereign wealth funds? What does it mean for the Santiago principles, which were written for a very different world and a different type of sovereign funds? One's less strategically oriented, both at home and abroad. I know that's a kind of double-barreled question, but
no, those are great, and those are really great and important questions. On the first point, you know, I certainly worry about that. I think we all do. All of us who think a lot about sovereign funds and recognize the important role that they do play and can play. We worry that fracturing is going to continue or maybe exacerbate. I hate to say it, but I think time will tell over the next few years on how you know, how regulators respond. As I said, I think that they may, at least in the next year or 18 months or so, probably continue the trend of restricting investment and thinking about imposing new barriers. But I also feel that some of the fears that we all saw in 2007, 2008 about the rise of sovereign funds generally really were allayed over the years, where by and large, sovereign funds behaved really as wealth maximizing investors that behaved in predictable ways that I think put regulators at ease. So my hope is that will, you know, they'll continue to recognize that. You know, thinking about say, you know, Latin America, thinking about just how funds should position themselves, how it might change deals. I guess I certainly worry that some countries are going to make themselves not great destinations for investment. And I don't think any of us want to see the universe of deals shrink in any way, but I think that that's probably happening when you add in some of the transaction costs associated with going into certain countries and trying to get a deal done. If those transaction costs become so great that it really makes it just not worth it anymore, maybe that will increase flows to places like Latin America that are becoming more open, or that we would hope would become more open. So I'm not sure if I got to your last question.
No, but that's good. But I want to move on in the time that we have, plus give time for some questions. And this goes to both you and Hugo. What are your thoughts on the long-term impacts of COVID, of the pandemic? To make it specific, what does it mean for sovereign funds? Some of these issues that we've touched about, and specifically in related to that, we saw in the report and in the presentation that Javier gave that there is increasing focus on sustainability in investing in green technology. But at the same time, we recognize that many sovereign funds, the very largest, are the source from hydrocarbon revenue, and those economies are still very much dependent on those revenues. So what can you say, either of you? I'll give it to Hugo first. What does the future hold?
Great question, Adam. A tough one. Look, why don't I have a go at answering it? I'm sure Paul can. I'm actually going to answer your question in two parts. I'm going to come up with a short-term answer and a long-term answer. So just in the short term, you said the impact of COVID. One of the interesting statistics in the report was that out of the 43 billion of deals, or 165 by number, 110 of them were done by GIC and Temasek. I think that's a pretty pretty strong statistic that 2 funds did 110 of the 165 identified deals. And I think when you try and unpick that, what you realize is that those funds are 2 of the funds with probably the most advanced deal sourcing, execution, and transaction records. And I hope that, to Paul's comment, that not only does the deal, both the volume of deals and destination of deals expand after COVID, but I also hope that the number of deals by different types of SWFs also expands after COVID, because I think that natural contraction probably helped accelerate deal doing to those funds that have been longest established with good track records and who have the largest investment teams able to deploy capital in let's be fair, in this time frame, a difficult period to take things to investment committee if you're looking to go overseas, versus a fund with, and also an internal focus as well. So that'd be my answer to the first bit. The second bit, quickly, look, I think you'll always see this pivot from hydrocarbon to green energy or the future of food, because it provides a natural hedge in the longer term. And so I think that trend will accelerate, and you'll see more of it as sovereign wealth funds try and adhere to the Paris principles. They try and go net carbon zero. There's a lot of great things that they're thinking forward on, including investing in ESG and looking at their investments with an ESG lens. So I think that trend will only continue. But I'll pass back to Paul, because I'm sure Paul can also comment.
Yeah, those are great points, Hugo. And I guess I just want to echo a couple of them briefly. I think that we see a number of funds really restructured or new funds that are created specifically to solve domestic problems. So again, we're going to see that kind of inward turn that's going to make some of these funds just focused on, say, sustainability issues in the domestic space. And we've talked about sustainability, but as a friend of many of us and colleague to us, Diego Lopez has argued, we're also seeing this sort of shift to resilience, right? It's not just sustainability, but it's resilience for moments like this. And I think that sovereign funds are going to be part of that both sustainability program that countries are creating, but also part of a resilience program for shocks that may arise, whether from climate change or from pandemics or from other kinds of shocks that might arise.
Okay, thanks both. Given the time we have one question that's been put into the chat. And if there's others, please do so. So the question is from Cybran de Jong, and he wants to know if we can say anything about the pattern or identify in investments made by the Russian Sovereign Wealth Fund. And what he means by that is patterns in terms of dominance of certain sectors, so energy, hydrocarbons, renewables, life sciences, high tech, a preference for particular nations, geographic areas, and also which currencies are used for the investments. Is it mainly dollar-based, or are there a trend in investments shifting to alternative currencies? And I'll pose this question to Javier as well, if Javier wants to rejoin, if Paul or Hugo doesn't have an answer to this.
I think, well, certainly from my side, I think Javier is probably best placed.
Okay, thank you, Hugo. Thank you, Adam. Definitely, we can answer. So thank you for asking. I don't want to interrupt the panel, so you can continue until the end because we have no other questions. So I want you, if you want to continue and highlighting some of the ideas that you have had. But yeah, basically on the Russian thing, well, Russian Direct Investment Fund is a fund that it belongs to this group of strategic funds that are doing domestic deals and that are used to attract international investors and to channel their investments into the Russian economy. One interesting thing about the Russian Direct Investment Fund, the RDIF, is that they have been able to attract capital that is deployed in many different regions in Russia, right? So in one way sovereign wealth funds can help development of countries is that they can channel capital and then they can deploy it into regions that maybe are not that easy to access to international investors. So that's one big question. All the deals are made basically in rubles, but one of the things that we have just observed is that many of these deals happen to be in the biotech space. So again, this is also a way sovereign wealth funds can use this vehicle in a strategic way so that they can attract international investors and deploy capital into sectors or industries where they believe there is a strategic value they can extract from it, right? So there is a strong bias into biotech over the last 10 months in terms of Russian direct investment fund activity. And just to answer to this, this belongs to this higher or larger trend among sovereign wealth funds that is growing even in terms of membership of the Association of Sovereign Wealth Funds, right? If you think about sovereign wealth funds, they were defined in a way that they excluded those that were investing only domestically, right? As of today, more and more new funds are just simply, or let's say simply, they are just focused on domestic deals and domestic transactions. So this has been a tremendous shift in terms of the objectives of sovereign wealth funds that is manifested very clearly in the activity and the success so far, at least in attracting capital of the Russian direct investment fund model. Definitely, that was the fund that initiated this kind of domestic focused co-investment programs or funds. They have been followed by France, they have been followed by Italy, Ireland, of course, when they did this change of activity and so on, right? So yeah, the answer is like they have been doing a lot of biotech. Most of these deals are in domestic currency. And the key thing is that probably they have been able to attract capital and to distribute this capital more or less equally into many regions around the country, right? In an extensive country like Russia, that's so relevant, right? It's not just that they focus into the two main cities, but they go beyond this. And they are able to reduce this asymmetry of information that Paul was mentioning before, right? And that you can use, as Adrián said, in the case of Latin America, you can use this as a catalyzer of international capital into the strategic sectors of the country, right? Yeah. So yeah, I'll stop here. The question. I don't know if we have others.
Yes. Thank you, Javier. There's one question we have that I can see from Philippe Pronost, who says he would like to know which sovereign wealth funds are interested in currently investing in infrastructure in Europe across from green to brown. Do we have any information on which funds specifically are looking to invest in Europe? Perhaps Hugo would, or Javier.
Yeah, well, we didn't cover that specifically, sovereign wealth funds interested in the future of infrastructure, but of course, I mean, we have seen that with many European countries using let's say the European recovery funds will be key in terms of attracting other co-investors to enlarge the capacity of these funds. So definitely, I mean, at least in the case of Spain, where I live, and because of the sponsors we have here at ICEX-Invest in Spain, one key element of the recovery of our economy, and I think many other countries in Europe after the pandemic, will be the wise usage of these European funds, right? And only through co-investments or leveraging of these, let's say, defining properly the type of deals that you can engage on after the recovery or during the recovery, probably will require further capital that is not just covered by the funds, the European funds, I mean, coming from the European Commission, but instead will require co-investments. So that will open the door to many sovereign wealth funds that are quite strong in infrastructure. And here we can say Abu Dhabi Investment Authority. We can talk about Kuwait Investment Authority, which has its own infrastructure subsidiary. We can say even Norway, which is thinking to deploy capital into infrastructure, renewable energy, right? That can open the door to this new unit that will come from the largest sovereign wealth fund on earth. We can say China Investment Corporation. So it's a bunch of sovereign wealth funds that are very strong in infrastructure that can be key players in the recovery process of Europe because of the co-investment between this program and their own capacity. Definitely that can be one solution.
Okay, that answered the second question about investing in Spain as well. So we're now past 3:15. So I think we'll stop. So I'll give it to you. Thank you again for having us on this panel, and thanks to Hugo and to Paul for answering those questions. I hope the audience appreciated it, and I'll leave it to you, Javier, to close us out.
Yeah, so thank you, Adam. I just want to say thank you to Adam, Hugo, and Paul for this amazing panel. That was really useful, so insightful. I'm really glad that you are part of this. So I'm really happy to collaborate with you, and I hope to continue doing that in even more frequent fashion in the coming months and years, right? Because I think, as you just pointed out, we are living into a period of tremendous activity and changes, mainly changes. And we will see in the next report probably what is the, in fact, the long or the mid-term reaction of this long-term investor, right? Are they really switching into renewables? Are they really switching into alternative sources of energy? Will sovereign funds be affected, or countries be affected by their own FDI regulation, limiting or increasing the scrutiny of international investors? We will see that in data. We will be able to observe also the continuing or not of this trend on biotech. Is it something that happened because of the virus, but maybe because of the pandemic vaccine rollout, we will see a relaxation of that interest or not? And this move into, let's say, more sovereign wealth funds doing activities rather than less that we have observed this year will be also key in terms of BC, right? And what kind of niches in technology are these sovereign wealth funds interested on? I mean, we highlighted food, but we have said other things related to mobility and other things like, for example, data and artificial intelligence, right? Anything related with robotics and the future of Industry 4.0 could be of their interest in the near form, right? So we will see what is their real direction. And thank you very much to all of you panelists, our dear panelists, and also Oscar and Alberto for the introductory words, my co-author, Adrián Blanco, in the Latin American area. And thank you all. Just simply to say that in March 17th, we have another event jointly organized with the International Forum of Sovereign Wealth Funds. I invite you all to participate. You will get the information. And I also invite you to download the report. Now you can download the report in the links that we have posted in the chat, both at the ICEX-Invest in Spain website and the Sovereign Wealth Research at IE. You can download the report. So welcome to the report 2020. I hope you enjoyed the reading, and thank you very much for being part of this also through your questions and your participation. With much further ado, I just want to say bye to all of you and stay safe. So goodbye.